feet. Right, so without further ado, I'm going to ask the panel to introduce themselves, but I'll start off by saying I'm Julia Dreblow. I run a small business called SRI Services, and we run a database of all the retail investment funds in this area, which is free to go onto, free to access, and we get all our information direct from fund and portfolio managers so that everyone in the world, or particularly the UK, it's UK based, can see what's available, because I think it's massively important where we invest, and research shows us endlessly a lot more people are interested in actually ever get advice on this area, so I didn't want to put any barriers to access to information to people in front of people. So that is Fund Eco Market, that's the site I run, but we're SRI Services as the company. And without further ado, I shall ask everyone to introduce themselves and what they do. Stuart, please first.
Hi, I'm Stuart Burnside. I work for M&G, which I think is not a small business.
No, quite reasonable.
So M&G itself is a FTSE 100 listed company. It's comprised of two parts. There's an investment manager, which is where I work, called M&G Investments, and then there's a business that's essentially the legacy Prudential business, so pre-fund, things like that you might come across. So that's a life company and also advisory services. And then within the investment manager, M&G Investments, I'm the head of product sustainability and governance, a snappy job title, which essentially means I own all of the regulated point of sale documents, prospectuses, KIDs, shareholder communications, all of that stuff, all of the designs of our sustainability features within our products, and then all of the evaluation of those products. So that's broadly my remit. And in contrast possibly to some of the other people on the panel, what I'd say is because we're a very large business and a mass market house, I wouldn't describe us as a sustainability specialist. We have a number of things that are and aren't sustainability, and therefore probably a lot of my interest is in creating big models that work in multiple places. We do have some very dark green stuff as well, but there are others with considerably more expertise on that than me who we're about to hear from.
You have real experts in this area, but you have people that do other stuff as well. I wouldn't put yourself down like that. I know being a big company, it's very easy to feel the need to do that, but you do some terrific work and have moved into this area and really, really got your heads around it, which is brilliant. Miranda, by contrast, has been doing it for a very long time. So Miranda, please.
Hi, I'm Miranda Beecham. I'm Head of Responsible Investments at Aegon Asset Management UK. Aegon Asset Management UK is a part of the larger Aegon Group, which is of course a global insurance group. We have been doing responsible investment product for a very long time. We started our first ethical fund back in 1989, and we have progressed through different types of environmental, social, governance themed products since then. And my responsibility really is to help support those products, to oversee the ESG integration, and also to take part in doing all the active ownership and engagement and voting, etc.
Louisiana, who kindly stood in at the last minute for a colleague who's been taken ill.
Thank you. Lovely to be here. My name is Louisiana. I've been with EQ Investors for 8 years. EQ Investors is a London-based B Corp wealth manager. We manage different kinds of sustainable portfolios for different kinds of sustainable preferences. Our clients are, Mr. and Mrs. Miggins on the street, as well as loads of financial advisors that take care of their financial needs. And they sometimes will recommend that they invest with us if they have sustainable investment preferences, impact investment preferences, and really want to be in touch with their investments. And my role at EQ as head of sustainability is to make sure that we don't greenwash. So I'm like the internal greenwash police. I look after our reporting, and I also manage our stewardship program, which I'd love to share more about later.
David?
Hello everyone, so my name's David Nicholsby. I am one of the investment directors at Rathbones Greenbank Investments. We are a wealth manager and we specialise in building investment portfolios for clients that want to align their money with their values. What does that actually sort of mean in practice? I think it's a lot of jargon when I say things like that, but we classify the companies that we invest in into 3 categories. A, for companies that are acting to avoid harm. B, for companies that are benefiting people and planet. And C, for companies that are contributing to solutions. And then it's my role to meet clients, possibly any one of you in the audience, find out what your values are, and then make sure I build an investment portfolio that is completely aligned to your values.
Thank you. And can I ask you to quickly comment on whether or not there's any areas that you just won't invest in at all across your business, because this is a trend I'm seeing, a little bit more of that kind of thing, but not everyone does it. So David, would you like to start? We'll come back this way.
Yeah, so we have a sustainable investment framework that means that we avoid what I classify as the traditional sin sectors. So no exposure to companies in the arms sector, no exposure to tobacco stocks, no exposure to oil and gas companies and fossil fuels. And then we actively try and look for those companies that I spoke about already from a positive point of view.
So those exclusions, though, are for particular funds or across the group?
Across the Green Bank group.
Louisiana?
Yeah, sure. So we also only manage sustainable investments at EQ Investors. So to add to that, we also add gambling, adult entertainment or pornography. And I think that's probably it, and matching the classic sins. But I think beyond that, it's about environmental, social, and governance is really important to create real financial outcomes, no matter what someone's, I guess, personal values are. So we integrate that for risk management purposes, just baseline, across everything, because it's really important. And we also manage climate risk across our portfolio. So it's not just about those couple of sector exclusions.
Cool, thank you.
Now we run both responsible investment products and non-responsible investment products. So we do have a baseline policy which will exclude the controversial weapons, it will exclude the worst of the fossil fuel expansion and the most intensive activities. But within our responsible investment products, they have got their own set of exclusions aligned with the client preferences. So there are multiple different.
And Stuart?
Yeah, so similarly, we're a big house with lots of different things that we do. So house-wide, we would, similar to Miranda, we would be covering controversial weapons and thermal coal. We have a position on that. And then, depending on the fund range, we would then add additional exclusions, but also different types of builds. So you might be looking at things from a portfolio construction. Your average levels in something such as ESG scores might be above a benchmark rather than it necessarily always being an exclusionary approach. Where we do go to exclusions, that tends to be on things that you would find obvious, like tobacco or digging up the Arctic, and then there is a layering up depending on the nature of the product where more exclusions might be seen to be appropriate.
Thank you. And I think that question is particularly pertinent these days because sustainable investing, ESG, all things in this area are under quite a lot of pressure. But what we're seeing is we've got a number of firms who've drawn the line somewhere or another saying we can't just ignore the impact of things. There are certain areas where we look at this is clearly destructive, clearly going to kill people. So it's really interesting, I think, that there's more and more interest in doing that kind of thing. And why is it important? Well, there's been research done by the FCA, the Financial Services Regulator, a number of times. The last report was out 2 years ago. And what we found was that you had 72% of people who wanted to make money and do good. And there were a lot of areas that people expressed concerns about. But I mean, just as a broad thing, financial services companies, it's quite dated now in some ways, I believe, to completely ignore this stuff. So you have a baseline level and then you go above and beyond that for clients who've got additional needs. So can I start then with a quick question? It's going to be ever so hard for me to ask questions to the audience because I can't really see you. I can see a little bit better if I do that. And there you go. Can I ask for a show of hands, please, for those people who know something about sustainable, responsible, ethical investment, whether you work in the area or you have investments in that area already? Okay, so a number of people. So listen, if you have any questions whilst we're going through, can I just ask you to wave at me or throw something at me? Because if I'm not doing this, I can't really see you. But do please ask. We want this to be interactive, okay? It's a 1 hour session, and I will truncate the questions accordingly. If you've got questions you'd like to ask, please do just ask them. Right, so that brings me on to why I chose this topic, or why we chose this topic, which is issues and opportunities in retail sustainable investment chain. Because one of the things that we found is you've got this 72% of people who are interested, but only a really small number of people that actually invest in this area. So there's a big knowledge gap somewhere, and I've worked with people like these guys for 35 years, So this stuff has had experts in it for a really long time, and there's a lot of knowledge, really interesting things that I think loads of people should know about, but it doesn't always get through. So what I want to do is to explore the different bits of the retail investment chain and how stuff doesn't quite necessarily make it through to the end investor. So can I just ask you all just in one or two words to say how close you are to end investors and really where you fit in the chain? David, shall I start with you again?
Yeah, I work very closely with end investors. That's my main role.
Cool. Louisiana?
I work with people that work with end investors, so I support on specifically difficult cases or where clients are really interested in understanding the underlying investments, but mainly my work is to support financial advisors to have the right conversation with their clients.
Cool. Amanda?
No, I work firmly in the asset management business, and so I don't actually get to speak to end investors, which is why I absolutely love coming here and talking to some of our end investors.
Yeah, so similarly, a little bit more distant from retail, we do have a direct-to-retail business, but I'm mainly concerned with manufacturing products that retail would tend to buy from somewhere else. However, that said, I have no business if people do not wish to invest with us, so it is absolutely in my interest to think about what the retail investor wants, even if I'm not talking to them as regularly as some of my colleagues to my left.
So I hope that gives you a flavour of the different approaches, and all these bits are necessary, right? You need people who are working behind the scenes doing compliance, doing research, engaging with intermediaries and speaking direct to clients. So that was kind of the object of this panel, to make sure that we had people with different areas of expertise. So please, when you're talking, if you can just help me draw out that kind of, well, this is how it fits in the chain, and with this bit we have a particular problem here, or this bit works really well if we talk in this kind of a way. So feel free to reflect the way it works in your world, where you work, and how the information comes through. So okay, let's start with a little bit of history on this, because where we are today is very much a function of, if you like, the giants we built it on. So a lot of people seem to think this area is maybe 5 or 6 years old, which is quite funny to some of us who, I was in my early 20s when I first got involved. Clearly I'm not anymore. Miranda, perhaps you could just touch on, sort of give us a flavour of really what it was like a long time ago and what the boom was then built on. So 15 years ago, 20 years ago, who was in this space?
Yeah, I think what was interesting is that there were always people as long back as I can remember, so you're talking kind of 40 years, long before I started in this industry, that were interested in investing in line with their values. So those ethical funds were built in line with those values in a response to them asking for it. But it kind of got stuck there for a while. We had the Kyoto Protocol, we had Enron collapsing, banking crisis, which then kind of started a focus on governance. So governance was very important for a while, but still the E and the S somewhat lagged, and it was very much a risk management exercise. But then I remember the Stern Review coming out. And I remember that day clearly because I don't think anybody ever realised how bleak that was going to be. It was really focusing on economic impact of climate change. And so that's when things really started to move, when people became very interested in the way that their money was working to try and help this situation. But you have to start somewhere. And so everybody had to start in trying to gather that information and work out how that could be applied into products. And you did kind of see the beginnings of those kind of products coming out who were trying to pick the leaders in this space. And as time kind of went on, we kind of saw a little bit of an expansion, but it didn't really happen until the kind of mid-2010s, when it was beginning to become mainstream and people really understood what their values were and how that could actually apply to a product. So they had different concerns, maybe veganism or climate change or human rights or whatever, and we saw quite a big explosion of different types of products as data improved through the 2010s, leading right up to the kind of glory boom years.
Which is what I'm going to ask Louisiana to go into. But for disclosure, I would just say really briefly, the ethical investment area is where I started off. I worked with two of the first fund managers in this area, and the second one I went to was the company that launched the first funds in this area. And that was born largely out of Quaker and Methodist concerns for the way the world was going, and they wanted to be able to invest in line with their conscience. They included environmental and social issues in that, absolutely. Avoidance of the apartheid regime in South Africa was absolutely core to them setting the thing up. But so this has changed loads over the years. So, Louisiana, would you like to take us on to what really happened, 5-6 years ago when it all went?
Sure, of course. So I think the background to this was also that there was COP being hosted in Glasgow, and I think that really ignited bits of the kind of sustainable investment theme specifically in the UK. The macroeconomic environment was really helpful to this. So I think something that is helpful to, to understand is that if you are a sustainable investor of any sort of form, you're much more likely to invest in companies that are faster growing than the average market, because these companies are seen to try to focus their business model on future problems, right? They're trying to provide a solution to future problems. They're trying to be more future thinking. And that often means that they're likely to grow faster than the market. And what that means in kind of the context of that time is that, so around the COVID crisis, I would say, is that if interest rates are low, companies that are growing faster than the market are, I guess, rewarded with higher valuations. And I think that's just important to remember there. So it was a positive performance story for a lot of sustainable funds at that time. And I think with that came the idea that you can have your cake and eat it, that you can invest in some sustainable companies, going well beyond just negative screening at the time, and outperform in the very long run. And I still believe that that's true, but I think what that led to is loads of fund managers, asset managers, and wealth managers jumping on the bandwagon, not deploying enough resource, but selling and advocating and marketing sustainable products to each and everyone. But I think what wasn't necessarily differentiated is who it was actually right for and who really wanted it, and who might be just there for the performance reason.
And they all thought they were right.
And I might come in on that because it's a good topic. So I think the challenge with some of this stuff is there's a part of it that's right, but then it gets overdone, as Louisiana's saying, right? So I'll give you a couple of examples. I won't name specific companies. You can have a guess if you like. So hypothetically, if an oil company were to spill oil everywhere, its share price is probably going to go down. So that is an example of a non-financial risk, its risk management of oil spillage, that can then have a direct financial impact on your portfolio. So even if you're not a sustainability investor, you need to pay attention to things like that. Another example showing that I do listen to my wife, there is a perfume company that I won't name, where the ingredients in their iconic perfumes are on islands that are quite close to sea level. So climate change and rising sea levels presents a clear risk to some of the ingredients in their perfumes. So if the sea rises enough, their smells will smell differently, right? Or they'll have to use synthetic ingredients, which is not really in line with the house values. So those sorts of things, as climate risk gets greater, and hey, we've all been outside today, good, wasn't it? You start to actually see it turning into financial risk. And I think what happened was, firstly, people started to talk about that more, but also in Europe, regulators asked us to talk about it more. And then, as Louisiana says, that started to gain a life of its own and snowballed, which feels like the wrong metaphor for heat. It started to become more of a thing that people said, well, that's a factor that would enable them to always be right, or at least they're implying that you're always going to outperform if you take these factors into account. And of course that's not true, because what you're doing is creating a bias in your investing, and then if things shift, as we're going to come on to later, then that can actually act against you financially, because of course you control your investments but you don't control the market.
Indeed, absolutely. And Stuart, I'm coming to you with the next question anyway. So what happened, say 5-6 years ago, was we had this massive boom. People realised this was material, it was relevant, it was going to affect financial returns. People got all excited with Glasgow COP. Everyone just decided this was all completely amazing. It was going to always outperform. And some of the sales messaging was, shall we say, a little bit shoddy, which is why people like myself were knocking on the door of the FCA saying, clients are being misled here. This is not going to end nicely. So what then happened is we had a series of bits of regulation both in Europe and in the UK. So I'm going to come to Stuart and ask you to give us a little bit of a flavour of what happened with the FCA, what steps they took.
Yeah, so I'll briefly touch on two different regulatory environments, Europe and the UK, if I may. And I've got a lot of sympathy for regulators because as a product manufacturer, if you wait to be told that somebody wants your product and then you start building it, you end up building it maybe a year or 18 months later, by which point they don't want it anymore. So you've got to anticipate. And my life cycle's maybe 18 months, something like that. As a regulator, you've got to, in the UK, you've got to get through HM Treasury, you've got to do all sorts of stuff. So your life cycle's more like 5 years. So you're frequently regulating for something that's already happened and might not even be happening anymore, because that's unfortunately the speed of the process. And that's just a fact of life. That's not a criticism. So two things happened. So firstly, in 2021, the European regulators created a thing called SFDR. And what that sought to do was ask us to talk about this topic in a specific kind of way. Nothing wrong with that. It was basically put up or shut up, tell us what you're doing, and then report on the fact that you've done it. But what that also did, because of the way it played out in the regulation, was it massively stimulated demand because distributors became obliged. Distributors, is jargon for people that sell to normal people. And they started to ask those people, humans that they're interacting with, more and more detailed questions about whether they wanted sustainability products. And because of that, and the risk, and risk feels like the wrong word, but the risk that that person said yes, the products that those European distributors wanted increasingly needed to have sustainability characteristics. Maybe not loads, maybe not dark green, but needed to be doing something, because then that increasingly became the product that you could safely sell to the most people. And as a distributor in Europe, you've got less risk if you are selling something that does something, but maybe not lots, than you have if you have something that's doing nothing, and then you're relying very much on your client categorization to get that right. So it de-risked things for the distributors. That caused a massive stimulus of demand, and as a result, lots of asset managers were obliged to convert their products to have some sustainability features. So it's not really accurate to say that we all got very excited and decided to start flogging this stuff. Actually, we got told, if your fund does not convert to have some of these features, we will delist you, we will not sell your fund anymore. Right? So that's the way the impetus came. So then what happens is, clearly, some of that wasn't built properly, or it was misunderstood, and there were some issues around it. So there were some incidences of greenwashing. And also, I think we're very good at navel-gazing in this industry. There were some people that felt like all the products in this space should be dark green. Personally, I don't agree with that. But actually, if you've got a light green product and you've clearly said that is what it is, and people understand that is what it is, that's fine, I think. Not everybody agrees. So what then happened in the UK is the FCA said, okay, well, we've got second mover advantage in this case because Brexit, let's not go there. Although it is the anniversary today, and I know that because it's my birthday. My birthday coincides with the Brexit vote, joy. What then happened was they then started to regulate around greenwashing that had predominantly happened in Europe to say, well, we don't want that in the UK. And then that regulation, which is called SDR, arrived actually at the point where a lot of the wind had gone out of the sails of sustainability for various reasons. So firstly, the UK is just one market, whereas in Europe, you're selling to lots of people, both in Europe and wider. The Dutch tend to be quite interested in sustainability.
Can't imagine why.
I think they've not got enough little boys to put their fingers in enough dikes if it all goes wrong. I think that might be the issue. But so that you obviously, if you're selling to multiple markets, you go for a lowest common denominator approach. You're selling to what will sell in the most places, and that tends to be to have some sustainability features, and that's still the case. In the UK, that was less so. Maybe we're closer to America, who knows, let's not go there. But what then happened was you got this regulation coming in that was basically clamping down and saying, must not greenwash, really, really hardline rules, which terrified quite a lot of people, probably more than they intended it to, having talked to them since. And then you've got quite a significant amount of legislation about how to do very dark green products. But the bit in the middle just didn't really fit, and actually the regulation on that has become a little bit unclear, I think. And as a result, what's happened is that, combined with Russia invasion and all these other things that we'll talk about later, meant that you're selling products into a very heavily regulated field at the same point that investor demand has materially reduced. And what that's led to is people closing and merging away a lot of the funds. So it's reduced the availability. Some people think that's a good thing, but that's factually what's happened in the UK.
Yeah, I mean, there's multiple factors, and obviously you're a big firm that sells across Europe as well. There were US firms selling into the UK also, which was another dynamic where a lot of them were coming in saying, don't worry, we've got it, we're doing everything amazing, and it was like, no, actually you're not. And the regulation, having been involved in it since before it was launched, we didn't really want it to be all dark green at the time. It was just a matter of just get people to tell us what they're doing, please. And it just became, exactly as you say, it became very dark green. I'm very tempted to say, can we take a break for 2 seconds just to say happy birthday to Stuart? So, and thank you for being here on your birthday. It is much appreciated, especially the anniversary of Brexit. How blooming awful is that?
I will say it was a pleasure to be here, but not a pleasure to commute here.
Yeah. So, big thank you to Stuart for doing that. Yeah, commuting today. Wow, great fun. Miranda, we've touched on regulation a lot, and obviously if you want to throw anything else in around the regulatory side, please do. But beyond that, quite a lot else has changed in the world, hasn't it, since then? So would you like to pick up on that?
Yeah, absolutely. I think the biggest change that we've seen is the geopolitical change that we've seen over the past couple of years. As we've covered, there was a lot of big claims made by a lot of these products, and those products did exceptionally well in a particular market environment. And we've seen that market environment change because of war, because of energy crisis, etc. And we've seen that skepticism around these products and around net zero and all these kind of things actually becoming weaponized against us, which is quite sad. And we're seeing that attitude come across the Atlantic into the UK, and some of the political rhetoric that's coming out as well. And so it has been quite a tough market. And I think if you were just to read the headlines of any of the newspapers, you would think that ESG is dead, that there is no future to this, and you could get yourself quite kind of disturbed by that. But in reality, actually, the numbers don't lie. This is a $33 trillion business now. We've seen in America the asset under management of sustainable investments double in the past 10 years. We've got 44% of funds in the European Union are actually labelled as sustainable. So there is still interest in this. It is still probably quite a small...
Hence the pushback, because of the power of the industry now.
Exactly. I mean, it's still quite a small part of the overall market. I think in the UK, the Investment Association's last numbers is something like 7% is in these funds. But we are seeing a momentum behind this now. And there's been recent studies by Morgan Stanley and the CFA talking about Gen Zs and their interest in wanting to align their products to their values. And so the next generation of investors, those who are buying their pensions now that aren't going to pay out for the next kind of 40 years, really see the importance of being able to invest with that future in mind, or lack of future. And the other thing that we've started to see is the reality kind of set in that 1.5 degrees is not achievable. And so a lot of the kind of younger investors coming in, and also the investors that have been around for long enough, are actually realising that mitigation is not enough. We can't stop mitigation. We absolutely need to keep on going. We need to keep the temperature as low as we possibly can. But as we've seen outside today, and this is the hottest June, we had the hottest May in records, that we have to start adapting. And so that opens up other kind of avenues of examination of different types of products, of what kind of investments we should be making into these funds, because we have to keep adaptation in mind.
Thank you. David, can I... Sorry.
Just very quickly on that, if I may, I think that's also something, that adaptation point, where even your deep red states in America are doing it, they just don't call it that. Because you tornado-proof houses so you can insure them in the States, that's climate change adaptation. So people do it even in the anti-place.
Yeah, and we do quite often get tied up in language, don't we? and I guess quite often I've taken a fairly relaxed approach to it because I just know it shifts. I've seen it change so often. I mean, an Impact House, leader in Impact House at conference I was at the other day, Miranda and I were at, saying maybe it's time that we ditch the word impact. It's like, well, if the impact guys are saying that. So this stuff is dynamic. It's diverse and dynamic, and it always has been, always will be. David, can I come on to you to talk about maybe client attitudes to this? Are you seeing, people asking, do they care?
Clients definitely care. I think everyone's different in how they feel about sustainability, and everyone's definition of sustainability is also quite different. I've actually grouped clients into various different groups, but there's two main categories. The first is what I call the committed change makers. They're the ones that think sustainability has to happen no matter what. We need to press ahead. Governments need to do more. We as individuals need to do more, and their investments need to be as aligned as possible to a sustainable future. And therefore, things like net zero are really important to them. Making sure that they're avoiding all of those sin sectors that we've talked about already are not in their portfolios, and they've not got any exposure. And they don't mind if that means that over the short term they might underperform from a sort of investment returns point of view. We then also have the second category, which I call the sort of conscientious traditionalists. And these are people who know that we need change, but don't want to make too big a sacrifice. And I think, I'm not sure in the crowd if you can relate to one of these categories, but I think conscientious traditionalists are a lot more skeptical about particularly new technologies and don't want to jump ahead into, I think Louisiana was talking about, 5 years ago you could invest in anything and it would do well. Nowadays, that's not the case. People are a lot more skeptical in terms of making their decisions. I work with a lot of entrepreneurs, and it's really interesting to hear that even raising funds in the UK is much harder than in the US, because in the US they're a lot more willing to take risk, whereas in the UK we're more risk averse. And you see that not just in sort of people that work in the industry, but also in people making investment decisions. So I think, from a client-focused point of view, they are interested, but it does depend what their personal values are. Those that are committed to it don't mind, and as long as they're at the forefront of sustainable investment, that's all that's important to them. But for those who are really interested in what their money's doing and how it's working, particularly relative to non-sustainable or more traditional forms of investment, do analyse that and critique it.
Cool. Louisiana, what have I missed? You deal with advisors a lot. Any comments on that side?
I mean, I think what we've seen, so at EQ we almost started with the dark green and then worked our way backwards, not to traditional, but to kind of offer a light green approach, just because we realized that there are these conscientious traditionalists that need a solid portfolio that might be light green, but says it's light green, discloses exactly what is excluded and what it does on top of that. But there is a role for this, because what I think is important to remember is that not everybody is happy to jump full into the deep end right away with 100% of their pension money, especially because we have seen a couple of years of struggles through this industry. So I think it's important to take people on the journey and offer different kinds of parts of the spectrum of capital. This is a bit of language that people use in order to differentiate between kind of very, very highly focused impact investments and I would say kind of traditionally negatively screened investments. So not everybody wants to go dark green from the get-go. So it's important to take them on a journey as long as you tell them where you are on that spectrum. But one thing that is new in the last, maybe I want to say 2-3 years, is people realizing that, of course, it's important what you invest in and what you exclude, sure. Be clear on that, make sure that that's happened, that's like my job. But then what do you do then? And stewardship, I think, to me, although it's been around for a very, very long time in different guises, engagement, active ownership, these things, change language as well. But really the idea that you can invest in things that are currently gray, in a gray area, and use your active ownership, use your right to vote, use your relationships with the company management, go to AGMs and try to drive change actively. This has become a lot more popular actually as a way to express your values through your investments. And I would say that this applies to any investment, and you can invest. Theoretically, you can invest in every single thing in the world and try to engage with it and try to improve that. So it's not specific to sustainable investing, is what I'm trying to say. Yeah.
Thank you. Can I just throw out, see if there's any questions, because I'm aware we've got about 15 minutes left to go, and I've got a couple more questions, but I will truncate those. If there are questions from the audience, please do say. Do we have any? Someone on that side, Tom, if you could take the mic, please.
Thank you. Just to refer to what Louisiana just said, this morning I attended a very interesting workshop with a mix of asset owners and asset managers, and actually what was said is that excluding is not maybe the right solution, because you exclude from your portfolio the risk, but you don't exclude it from the planet. So engaging with corporate could be a good solution. My question is, I wanted to share one main takeaway from this workshop, and I wanted the opinion of the panelists, is that engagement and stewardship has become a key driver for corporates to change for good, but it has shown its limits. The one-to-one engagement is not strong enough to get outcomes, and it's very hard to track outcomes. And they discussed this morning about system-level stewardship. And I wanted to have your opinion on that, and maybe what you've been doing to move forward.
So, right, I'm going to throw that to Miranda, but while she thinks of an answer, which she's probably got straight away anyway, I'm going to start with views vary on exclusions, because obviously what we're looking to do also is reallocate capital to companies that need it to grow. So I want to defend exclusions a little bit, but they're not necessarily the be-all and end-all.
So I might come in on that a little bit more as well. So I think the panel you heard this morning is a slightly more institutional lens, that as an asset owner, you're going to allocate to an awful lot of things, and you're potentially thinking about engagement. Whereas from a retail lens, which is obviously our focus on this panel, what you might well have is quite a fundamental objection to a specific type of stock. So it could be, smoking killed my gran, I am not going to invest in tobacco, right? I don't want to engage with tobacco companies. I don't care about how much of it is vaping or whatever. I do not want that in my portfolio. The other thing, just to add some of the earlier remarks very briefly, giving you lots of thinking time here, Miranda, even though she doesn't need it because she knows stewardship backwards, is that what you want can vary even within the same person, right? Because we're all here doing broad brush strokes, people in this market this, clients of this type that. If you invest in a junior ISA, because you're lucky enough to have kids or grandkids or whatever your driver is, and you absolutely should if you do, by the way, regular investment in junior ISA is brilliant. That potentially creates a dynamic where you go, how am I going to talk to my child when they are, 12, about what I've invested in on their behalf? And do I want to say that I put their money into tobacco or whatever? Because actually at that point they might have some quite feisty views on lots of things, right? So actually the same person that's quite happy to do broad-based index strategies in their own right might have quite a dark green lens when it comes to junior ISA investing, for example.
Absolutely. Miranda?
Yes, I don't know if anybody heard the panel that was on just before this, but my colleague Audrey, who runs our ethical fund, was talking about the fact that those exclusionary-based funds actually invest in good companies. The consequences of excluding bad companies is that you invest in good companies. And there has been a great deal of rhetoric about the fact that engagement can make changes. And I'm not arguing with that at all. I mean, I've been doing engagement and active ownership for the past 30 years. That's been my life, and I absolutely love it. But we do have to be reasonable, and we do have to be completely honest that it does have limitations. With all the will in the world, I can talk until I'm blue in the face to an oil major about stopping drilling oil out of the ground. They will not stop doing that. So as an investor, if you're in an unconstrained fund and you're allowed to hold oil companies, you do have to make the decision at some point as to whether being invested in an oil company is the best place for your client's assets to be, taking into consideration all the risks and rewards taking into consideration stranded assets and what the future oil price looks like, what the future oil demand looks like. And then you have to make the decision, do you stay in that company or do you just come out of it? And so I absolutely do believe in stewardship. I've spent my entire career doing stewardship. But I am completely honest that I am a cog in a very large machine, and with everybody working in the same direction, we can make change. But there are limitations that we are not going to change some companies from doing their key kind of activity that have been set up to do.
Would you like to give a plug for the report, the IAA report, share the name in case we're talking to someone who happens to be in investment? As they might
Yes, yeah. If you are in the kind of more institutional space, with my other hat on, I chair the stewardship committee at the Investment Association, and we've spent a year looking at the problems within the kind of stewardship chain. And a lot of the problems are that instead of all pulling in the same direction with our asset owners and with the various other parts of the chain, we're actually fighting against each other, and that's not going to get the best results. So there's a quite large report called Realigning Stewardship that's been published. It's on the IAA website. I recommend you read it if you're having trouble sleeping. But you can read the executive summary, and it is the focus of the work that I am doing with the IAA at the moment, is to try and kind of smooth that whole chain out and to make sure that we are all pulling in the same direction so that we can have the maximum impact.
So the IAA being the Investment Association,
Yes,
which
sorry.
is the industry body for investment organisations such as Aegon and M&G. And Saccos. And probably EQ, I don't know. Anyway, they're big. They're everyone in the UK pretty much. So yeah, it's a real collaborative document, which is exactly what the industry needs, getting together and working out solutions to these problems. Okay, I'm going to come on a little bit, if I may, to the opportunities that today's climate has sort of presented to us. Miranda, I think I led with you on this, but do you have any quick comments you want to make before I move on to others?
Yeah, I think the one thing that's actually been quite useful in that it was very easy pushing on an open door, and we probably got a little bit complacent. So with the kind of level of pushback that we've had over the past couple of years, it has been actually really useful to re-prove to ourselves why we are doing what we're doing, how we are doing it, how we actually talk about materiality, how we talk about client preferences, and to really examine that we're doing the right thing. So from that perspective, it has actually given us a lot of insights into ourselves.
And any benefits from regulation, Stuart?
Yes, so there's always some benefits. I think, investing and advising for that matter is a trust-based business. You're asking people to trust you with something, and then you're acting on their behalf. And there's a lot of garbage on places like Instagram or TikTok or wherever the kids are these days. I don't bother trying to keep track. That is unregulated and dangerous. And that's not for one regulator on their own, because quite a lot of this stuff is outside of the FCA's purview, so it's for advertising standards and so on. But I think what I would like to see is a level playing field where people can trust each other and understand what businesses are trying to do. We will inevitably get it wrong because we're run by humans and humans make mistakes. But if we're trying to get it right and the regulators are trying to show us a definition, a common consensus of what right looks like, I think that's very healthy.
I entirely agree, thank you. David, I'm going to come on to you because links back to what Stuart has just said, but also, hands up here if you've struggled with the heat a bit today. It's been tough, right? I've run 3 sessions and it's like sometimes thinking I'm going to fall over. It's just too hot and we're going to get a lot more of this. So we've got to get ourselves from where we are today to some other place in the future where this stops getting worse and worse, because we're not going to suddenly get past 1.5 degrees and we've just hit bad and that's it, we're done now. It's going to keep getting worse and it's going to get a lot worse. So transitioning is a really big thing with international standards people and also the FCA regulators working with the PRA, so the banking regulators and others, talking a lot more about transition. So perhaps, David, would you want to expand on that and the role of how that's changing where we are at the moment?
So I think I'm going to flip that a little bit and just I think we as an industry for so long have focused on what products we can make, what exclusions we can have, or what positive screens we can have, and what we can invest in. but I actually think we can do more as a community to actually talk to the end client more, and really understand what it is that you're, first of all, looking for, but also, maybe have a conversation about what you actually need. And I think the investment industry for so long, and I'm actually going to ask a question, how many of you would like to maximize the amount of wealth that you have?
Do you mean invest absolutely wherever? Doesn't matter how bonkers it is.
When you're investing, are you looking to maximize the value of what you're investing and make the most money possible?
As opposed to, do you have limits?
Well, and keep your hands up for those people that have their hands up, and put your hands down if you actually care about where that money's invested and the impact that money's having, and maybe if you're willing to have a little bit less over the short term, knowing that money's actually doing good, but also making you some money. So most people, everyone's got their hands down, and I think that's an important factor that we need to talk about more. How much is enough for you to meet the goals and objectives that you have for your wealth? And then we can think about the products that are suitable for you.
So do you want to lead that into talking a little bit about performance and the role of that and how important that is to people?
Yeah, so I've got some fun figures here, and I thought we could play a little game. So
go ahead.
There's three levels of return here. There's A, which the global market has done, investing in all companies. Over the last 10 years, that's 166%. A sort of middle of the road, sort of light green version of that has done 126%. And then a very, very sort of dark green version of that has done, unbelievably, 169%. So over 10 years, those figures look really, really good. But over 3 years, the world has done 78.6%, middle of the road has done 57%, and the sort of dark green has done 45.97%. Now, knowing all of those figures, how many of you would invest in A, the world, not taking into account any sort of exclusions? Hands up. So we've got 2 hands up there. And how many of you would go for B, middle of the road, decent returns over sort of 10 years, middle of the road returns over 3 years? Got a couple of people. And then the third, over 10 years, has actually done quite well, but over the 3 years has done quite poorly relative to others, but has a very, very dark green screen. Hands up? Yeah, so, I think knowing things like that can really help.
Absolutely, for sure.
I'm going to cynically say the fact that you didn't get all the hands up suggests that quite a lot of people would have stayed in cash, even though they know they shouldn't, and would have got a profoundly lower return than A to C, and also wouldn't have thought about where their bank was lending their money to.
So this is where we would say, come and talk to us after the event, find us, we can help you. It's our job to make sure that you achieve whatever you need to achieve.
So is there anything else anyone would like to add in on what we're saying there, or shall I throw it out for questions again, because we only have a few minutes left? Are you happy for me to... Can I invite... Sorry, please do.
I just wanted to go back to transitioning.
Yeah, please, sorry, I forgot. I should have said yes.
No, it's fine. I think in general, most companies are transitioning. I always talk about sustainability having a moving goalpost, because really, even if you invest in a positive impact portfolios, which I would consider like investing in the creme de la creme of businesses when it comes to their sustainability right now, I'm still going and engaging with them because, even the wind turbine company that actually has a brilliant biodiversity policy and pays their worker fairly, maybe they could do better on, for example, diversity and inclusion. So there's loads of things that you can do. There's always more to improve. And I think so wherever you sit, even when it goes from light green to dark green, I think there's always an element of change. And I also think that the academics is changing, so the science is changing, regulation is changing. So actually, in general, if you get into the sustainable investment world, and if you're lucky enough to, either do it yourself or have someone guide you, like an advisor or investment manager, you will embrace questions and changes in methodology and so on. And it's exciting because it's really also partly our job to re-establish what is good enough for any investor across that spectrum and change it with that time. So
yeah, things change constantly, and that's one of the reasons I tend to encourage people to be a little bit cautious with terms like greenwash, because things shift and opinions vary. So tying
but
it down
there still is
specifically,
real greenwash also.
Yeah, there for sure, and green hushing. But anyway, that's a different topic. Not enough people talking about this stuff generally, so that's one of my big concerns right now. I'm going to ask if there's any more questions, because we just have a few minutes left. Can we come to Julian at the front here first, please, Tom?
Thank you. Fund managers and investment managers like a theme, and one of the themes I've seen creeping in of late is resilience, which is a terminology which seems to cover everything from flood mitigation and climate risk mitigation to potentially arms development and AI and oil and gas, etc. Just wonder, do you see that there's a risk of a resilience wash?
Who'd like to take
I'll do a
Louisiana?
really quick one. I think what's happened is that because of various anti-ESG stuff happening in the US, asset managers and corporates that wanting to continue on their corporate decarbonization path, adaptation path, embracing sustainability targets, have used it in order to go back to what we call financial materiality, which is trying to go back to what is material to the business case, right? And so I think that's where this has come from. It's not really thematic in my view. It's kind of being used in order to continue the sustainability journey without calling it sustainability. That's my view. I don't know about the resilience wash. I talked to a fund manager this morning, not represented here, who's launched a fund that is investing in like European defense, electricity, and kind of European onshoring. And I think it's partially that, like trying to think about less globalization, more localization. So it's a trend. I'm not sure it's necessarily washed, but
Any other comments on this one? Because we had a few questions actually. So I'll probably stop asking questions and just let the audience. So please, and we can go over by 1 or 2 minutes if you want. But Miranda, please, fairly brief.
Yeah, no, I absolutely agree. I don't know if it's going to be washing, but I do think that it is just a different way of phrasing good business. And so when we're looking at kind of ESG in the whole, and you're talking about resilient companies, it's just reality. And so perhaps those that are taking into account those risks are going to be more resilient. And that's just a different way of talking about it. I do think it needs to be better defined. But that's been true all the way along the journey of ESG funds, that there's new terminology comes out and then it gets closer and closer defined.
Not a word that's been shot down yet, so it's still okay to use, I guess. There are other questions. Tom, if you could take this. Yep, over there.
So, two-part question, short answers, welcome. So first of all, on sort of from a retail investor's perspective, how easy or difficult is it for you to explain screening to them in places like oil is okay, but Arctic exploration is not, or defense is okay, but arms and controversial weapons is not, or metallurgical coal is okay, but thermal coal is not. So do you ever find yourselves in these conversations with retail investors? And then sort of the second part, I mean, I phrase it as a part, but it's not actually related. I just wanted to throw in another question. Is that related to the game that we just played? So between sort of the world investments where you basically invest in any company and then a light green approach, one of the first things that came to my mind when you threw that out there is that sort of the marginal sort of reduction in the reduction in the returns may not necessarily be a good trade-off for me, given the marginal improvement in sustainability that a light green fund gives me, and that's why I would rather just go full dark green or just like not care at all. So is that something that you guys come across as well in your conversations?
Yeah, so why don't I start us off, because I think it's a different answer between manufacturer and advisor.
Yeah, a couple of
right?
sentences
So
each if you could.
manufacturer, we are not in the business of saying this is okay, this is not okay, right? What we're in the business of doing is saying we are doing this and we're not doing that, and then you, the investor, assisted by your advisor, decide whether that works for you. To your second question, I personally think it is incorrect to say that there is always a trade-off between sustainability and financial performance, even though that seems to be very in vogue of late for various reasons. It's factual of late, not always factual. What exclusions do, and sustainability themed investing does, is it gives you a style bias, right? So in the same way that if your style bias is growth or value, in certain markets it's better, in other markets it's worse. You're never right 100% of the time, otherwise, I don't know, I would be Warren Buffett.
And that 10-year time period shifts all the time. I think Miranda's trying to get in, and David as well, and then we will wrap up.
Yeah, I think exclusions are the easiest, most transparent products that you can have. We've got a policy on the website. It's very explicit. We invest in this, this, and this. We will not go near this, this, and this. I don't think that's an issue. I think investors understand that. In terms of trade-offs, it's just a matter of timing. As Stuart said, there is biases built into these products. They will perform differently from a wide benchmark. Doesn't mean that's wrong. They're going to perform differently. And people forget that during the COVID years, these funds were absolutely flying because they were heavy on healthcare and tech. So, swings and roundabouts, they just perform differently.
So David, if you could give your answer, and then if you want to say any other final comments, anything important you feel you might have missed.
So I'll try and tie all that together. So on the first question, I think our role is to make sure that we're specialists in what we do, so we only get people that are interested in some level of sustainability. If they weren't, they'd probably go somewhere else. But our job is to really have that conversation with them to find out what it is that they're interested in. And then on the second point is, when they do make that decision of what they're interested in, it's really important that they're comfortable with that and they're aware of what might happen over the short term, because, when Donald Trump decides to do his next thing, that's going to impact some other sector of the market. And the client needs to be aware of what's going to happen, because you don't want them to be, that age-old saying of, buy low, sell high. You don't want them to be selling low, buying high, because, that will give them a negative view of the investment world. So, and completely agree with what Stuart said, and that's why I gave the sort of 10-year figures. If you have a long-term time horizon, anything can happen. And my personal view, which is why I work in the industry, is that if you adopt a sustainable investment approach, you're likely to achieve long-term, sustainable, positive investment returns.
Louisiana, any just final sentence or two, anything that's been missed?
I think on exclusions, quickly, I think it's important that you ground it in some degree of research and just don't pull out a number from thin air, and also understand what the impact of that is on the universe. For example, just going on military, right? If you were to say zero military exposure, you might exclude something that is kind of selling a tire, right? But that's not really what you're intending to do, right? So there's degrees in which you need to be nuanced about it and researched about it and figure out how that influences the investment universe on purpose. I think in general, just to finish off, I think what is important about sustainable investing is that you have the transparency that you need in order to make that choice, and either you find that yourselves. I think I just wanted to give a shout out to Julie and her platform, because I think she does a great job at bringing together people like us, fund providers, but also likes of Greenbank and EQ, trying to show what we actually do, showcase where you can find all the research, and then you can make your own mind up, or you can find an advisor that actually helps you through this difficult confusing mess that we still are in. But you know what? Anti-greenwash rules is really kicking some up the butt. Sorry. And hopefully there'll be more intentional products out there, and everybody will find their right place. Thank you.
Miranda? No. Stuart?
We all are frequently guilty of thinking too much. We try to find something sustainable, worry about it, don't actually invest in it, and then our money's in a bank lending money to oil companies. Or we try and time the market, and then we're still in cash when it goes up. Set up a regular savings plan for you. set up a regular savings plan for young relatives in a junior ISA, and if you're sustainability curious, stick 25 quid a month in and see how it does.
Thank you. Great way to finish. Right, we have run over, which I don't like doing, but that was a great question, well worth asking, or 2 questions. Can I just say, we can stay at the front here for a few minutes. So if you have more questions, I'm aware there were some hands we didn't get to. Please do come and talk to us. We are all people who can talk on this day and night, so please come and engage with us. But in the meantime, can I just ask you to thank the panel? And of course, we would like to thank you for joining us. It's late in the day on a really hot day, so I am so appreciative that you spent your afternoon with us, the end of your afternoon. So thank you so, so much. And please do come and talk to us. Have a good evening.